This video was brought to you by Brilliant. A couple of days ago, Republicans in the House of Representatives passed Trump's One Big Beautiful Bill, a 1,000+ page megabill crammed with essentially all of Trump's campaign pledges. Trump was unsurprisingly jubilant, claiming on Truth Social that the bill was, quote, arguably the most significant piece of legislation that will ever be signed in the history of our country. But the bond markets were less impressed, with the yield on long-dated US government debt rising to its highest level since 2007, only a couple of days after Moody's, one of the big ratings agencies, downgraded America's credit status. So in this video, we're going to take a look at the recent rise in long-term Treasury yields, what's driving it, and what it means for the US more widely. Who's the best politician right now? Hear our thoughts and argue with us on our podcast, the World Leader Leaderboard. Find it on the TLDR Podcast YouTube channel or in your favorite podcast app. So to understand this story, you need to know a little bit about how bond markets actually work. In short, when a government borrows money, they do it by issuing bonds. Bonds are essentially defined by three things. The face value, that is how much the bond costs in the first place. The coupon, that is the annual interest rate that whoever owns the bond receives. And the maturity, that is the date when the issuer repays the bondholder the face value of the bond. To give an example, the US Treasury might issue a bond with a face value of $1,000, a coupon of 5%, and a maturity of 10 years. If you bought that bond from the Treasury, you would basically lend the US $1,000. The Treasury would pay you $50 a year for the next 10 years, and after that 10 years, they'd return the whole $1,000. Importantly, however, the effective annual interest rate, or yield of a bond, can change if the markets decide that they don't want to pay the face value. So, for instance, if I tried to resell a bond that I just bought, but the markets were willing to only pay a face value of $900, whoever bought that bond would effectively be paid a higher yield. After all, $50 is more than 5% of $900. It's more like 5.5%. And after 10 years, this new bondholder would also get an extra $100, because the Treasury would pay back the full $1,000 face value. But this new bondholder only bought the bond for $900. This means that the effective yield would actually be over 6%. Now, this would be bad news for the Treasury, because it would imply that the US would now have to offer bonds with coupons over 6% in order to attract new buyers. And this is essentially how governments decide what coupon they offer on new bonds. They look at the effective yields of already issued bonds and then offer effectively the same rate. Anyway, in normal times, bonds with longer maturities offer higher yields, because the longer you have to wait to be repaid the face value, the greater chance there is that something will go wrong. For instance, if the US Treasury offers me a bond with a 1-year maturity, I can usually be pretty sure that they're going to pay me back. But if they offer me a bond with a 30-year maturity, which is basically the longest dated bond that the US Treasury issues, well, it's a bit harder to say, because who knows what's going to happen in 30 years' time. This is why the yield on a 30-year Treasury is usually higher than that of a 20-year Treasury, which is usually higher than that of a 10-year Treasury, etc., etc. To see this, analysts often look at a graph comparing yields on the y-axis and maturities on the x, known as the yield curve. And because longer-dated bonds generally have higher yields, the yield curve usually tends upwards. However, for much of the past couple of years, this hasn't really been the case. A year ago, for instance, bonds with 5, 7, 10, and 30-year maturities all had pretty much the same yield. And for much of the past couple of years, short-dated treasuries actually had higher yields than longer-dated treasuries. In other words, the yield curve has been inverted. However, in recent weeks, this has all changed, thanks to a super sharp spike in yields on long-term treasuries. Early this week, for instance, the yield on 30-year treasuries rose to over 5.1%, the highest level since 2007. And while the move in 10-year treasuries hasn't been quite as dramatic, they're still currently trading at about 4.5%, up from 4% earlier this year, and well above the 3% or so they averaged during the 2010s. Interestingly, short-dated bonds like the 7, 5, and 3-year treasuries haven't moved anywhere near as much. So what does this all mean? Well, as with anything in the markets, no one knows for sure, but at least some of it seems to be a revision to the mean. After all, longer dated bonds should have higher yields than shorter dated bonds, and it was weird that they didn't in 2023 and 2024. So this was always going to sort itself out eventually, and especially once interest rates stabilized. Nonetheless, while it is true that the yield curve was always going to de-invert at some point, it's now gone pretty far the other way, due to the fact that yields on longer dated treasuries are now at historic highs. So what's this about? Well, some of this is a reaction to a weak auction earlier this month, when the Treasury tried to issue more 20-year bonds, only to find out that, well, no one really wanted to buy them. And this has made investors anxious about the demand for long-dated treasuries and the liquidity in the long-dated treasury market, because no one wants to be stuck holding bonds that they can't sell. But the main reason for the rise in long-term treasury yields is America's fiscal position. In short, the markets just don't trust that America is ever going to get its ever-increasing debt under control. This is why the 30-year yield spiked over the past week, as it became increasingly apparent that the Republican majority in the House of Representatives would pass Trump's One Big Beautiful Bill unamended, despite the fact that it currently involves a slew of unfunded tax cuts that the Nonpartisan Committee for Responsible Federal Budget estimates would add at least $3 trillion to the deficit over the next 10 years, as well as over $5 trillion more if the temporary provisions, like the no tax on tips and overtime, are extended, which seems pretty likely. In practice, this means that the US will continue to run deficits of around 6 or 7% of GDP for the next few years, and America's debt pile will probably rise from about 123% today to around 150% in 10 years' time. The rise in long-dated treasury yields is basically the market saying, sure, the US probably won't go bankrupt in the next couple of years, and the economy currently looks all right, but we're not too confident about the longer term. And well, you can sort of see where they're coming from, given the fact that both the Republicans and Democrats lack the political confidence to even talk about serious spending cuts or tax rises, despite the ever-widening deficit and deteriorating fiscal position. Doge was supposed to square this circle, but it failed to even make a dent in federal expenditure, and Musk has apparently given up on it. So it's now hard to see how America ever gets its debt problem under control, especially given its increasingly dysfunctional politics, and this has made investors understandably anxious. If you're engaged with complex topics like these, it's probably fair to say that you're at least somewhat interested in improving yourself through interesting, engaging online learning. If so, you'll be interested in this week's sponsor, Brilliant. Brilliant is a learning app designed to help you understand topics from the ground up, on everything from maths to science to AI. Each lesson is filled with hands-on problem solving that lets you actually play with concepts, a method that's proven to be 6 times more effective than just watching lecture videos. To add to this, their app is designed to help you learn wherever you are, with fun, hands-on lessons that you can do whenever you have the time. So instead of mindlessly scrolling on social media, you can get smarter in a few minutes each day. For instance, Brilliant's newly updated science course helps you make sense of our universe at entry level, from the mechanics of simple machines all the way up to black holes. The course helps you better understand the world we live in by explaining the physical principles that drive modern technology, while helping you develop your scientific intuition through visual, interactive problem solving. To try Brilliant for free, visit brilliant.org/TLDR, scan the QR code on screen, or click the link in the description. By doing so, you'll get 20% off an annual premium subscription, and they'll know that you came from us, which really helps us out.